kind of just like, what is your advice on getting started with investing for students who are managing school expenses on their own? And how can they like balance everyday costs, save for future goals, and figure out when it actually makes sense to start investing, especially while they're dealing with student loans or a part-time job?
If you have student loans, they're coming a little bit later. And as somebody who graduated with like 30,000 to student debt, trust me, they're coming. And one of the challenges that I will add to the plate is that if you're facing student loans, your parents actually need financial guidance more than you do.
Welcome back to another segment of Bajo Table Talk. The topic right now is investing with intentions. And I, your co-host of today, I'm Kelly Garambe, along with
the founder of Bajo Table Talk, Antoinette Mugisha.
Sana Mugisha. I'm a senior in high school. I'm very excited to learn more about financial wellness.
And I'm Jean Paul. You can call me JP. I'm a financial wellness expert. And I'm here to share and teach on investing with intention.
We're excited.
I'm excited that everyone's here and you guys invited us. So I guess I'll just introduce the topic of the day, and we can dive deeper into it as we go. And I know this is going to be the most exciting of all the topics because it involves making money. Mm-hmm. And it involves making money potentially in a passive type of way. So if there's anything people enjoy more than making money, it's having to not do something extra for the money. And that's what we're talking about today. Investing with intention. Being able to align your values, things that you put as priorities, and then putting your money aside, putting it in different markets to be able to get you more money to achieve things that you find that are valuable to you, whether it's retirement, whether it's vacations, whether it's about things that you put value to. You set the intention towards that. So we'll talk about how do you set your goals, understanding the timelines for your money. We also talk about how to take risk and how to approach the market as far as using your financial advisor or doing it yourself. Do you have the power to do it yourself? And we'll also talk about when is the right time to start and how can you get started. I hope you're excited. And
yes.
There's a ton of questions. So for me, the first interaction with the world of investment came way after university. Like I was working for the bank at the time, and I did not have investments for 2 years into the bank. So I still waited another 2 years working next to the investors before I got into investment. Before we get any deeper, I wanted to find out how has everyone's, what was the first interaction with investing? And specifically, I'm talking about whether real estate or stock market, kind of limiting in those two.
So,
yeah.
Me, I would say when I came to Canada, I came here in 1997. Of course, new country. You need to be integrated to a new culture.
Right.
And money is part of it, part of the culture that you need to know how to use it, how to navigate.
Yeah.
So I invested in real estate in 2002. That was after 5 years.
Wow.
That's where I bought my first house. But with that, it's not that I was more knowledgeable. It's just when you get that, I would say, you want to just have something to your name.
Yeah.
You don't necessarily that you knew about, okay, if I buy a house, it's gonna, down the road, it's gonna give me this. Like, it was just have something on my name, and that's it. But I didn't have no knowledge that I can tell you. I didn't have no knowledge at all.
That's amazing.
Yes.
After 5 years,
5 years.
when you got here, you had your first property,
Yes.
your first asset. Would that be a fear of missing out?
No, actually, I think it's I would put that closer to
Realist?
a realist, because in Canada it's very hard to see somebody doing very well without seeing the real estate first.
Absolutely.
So when you see people who go into their house without knowing anything else, usually the idea is that, okay, this is what successful people do.
Yeah.
They buy a house. The house itself, as far as assets are concerned, it's not the highest.
Yeah.
There are some challenges in that investment. Yeah. But if you look at who in Canada has done well, homeowners are way above everybody else.
Yeah.
So it's a good investment. It's just more of a it's a Canadian reactive investment.
Yeah.
So it's a secure one, like this.
Yes, it brings an idea of security. I'll give you secure in that.
That's an interesting fact.
Yeah. Yeah. What was your interaction with investment
at first? Well, so the part about stock market and real estate, that's something I'm learning right now, right? And I think that's an enticing and how can I call it, an attractive side of investment I haven't learned, which is actually more modern. But for me, my first interaction with investment is I've invested first of all in like tangible things, right? Like I have a family. I wasn't born here, right? I've been here for almost 9 years now, but unfortunately, not as you. I wasn't able to buy any asset or property after 5 years. Yeah, but again, I've tried to invest in my siblings. Like I could tell her or him certain things, right? And like something we could work on, or my friends, right? So we invested in small companies, right? Like funded, little things, right? I started this landscaping company, right? It's little, right? About so I invested in tools. I went and got lawnmowers and tools and things like that, right? But I haven't gotten on the market, that can I use the word sexy part of investment? So yeah, that's really enticing, and I feel like it's mostly for people with so much money, right? Or am I wrong? No, it's not necessary for older people, right? I wish I could get in that, but I feel like it's more for people with so much money, right?
No, that's fantastic. The fact that you just said that, I think for a lot of people listening, that's going to resonate with them so much. It's like, I haven't done any investments, but I've done these ventures and I've done this venture.
Yeah.
But that whole stock market thing, the Dow is down 10 points, 15 points, I feel like that's
rich people stuff.
Yeah.
Big fish.
So we will discuss all about that. So you just opened the door for a whole bunch of people who are watching.
Yeah.
Be like, okay, I'm in the same boat. Like, where do I start? How do I start? Have I reached when I could start?
Yeah.
And I think by the end of this conversation, I will ask you the same exact question if you feel ready to start and you feel like you know where to start. And the answer on both will be yes. So let's go on with the conversation.
Yeah. So Tusana, what was your first interaction?
Well, I actually invested for the first time when I was about 13. Wow. And it was to my mom's nonprofit organization. Wow. So I definitely trusted her. But I think
trusted in the past tense.
No longer trusted.
But yeah. But being introduced to investing for the first time, especially at that age, I kind of translated that to okay, well, I'm giving her my money. It's not much, but I'm giving her my money, and I'm not going to see that money till a year later. So I was not really a big fan of it. I was like, why can't you just let me spend my money? I'm 13. I have enough money in my bank account. There's things that I want to buy. Exactly. There's things that I want to buy. I didn't get it at first, but definitely now I think it's something that I see myself doing in the future as well. Maybe not now because there's no... there's nothing to see, to be honest, but definitely in the future it's something I plan on doing. Yeah.
So definitely our next Baho CEO then. We're saying 1 year.
I mean, she already has shares.
Right?
Yeah. So let's kind of flesh it out a bit, because I think one of the concerns that you said, and he might have echoed, is that it's just the readiness of it. Like, it doesn't feel so close.
Mm-hmm.
Like, when we all know Christmas is coming.
Yeah.
Right now you're feeling like you're in April. If Christmas is compounding and market, you feel like you're in April. I need you by the end of the conversation to feel more November.
Mm.
So let's start with, are you ready? How much is enough to start? How much is too little to start? And I will start with a brief story of just a young man I just worked with about a week ago. I actually met him when I was doing one of the workshops. Usually the super long workshops are financial wellness, or in a nutshell. And I go from money personality types, financial wellness score, self-assessments, budgeting, investments, insurance, wills, power of attorneys. I do all of that. And he listened through all of that. This guy is 20. He works, I shouldn't reveal any of his. I mean, he didn't say the name. So he works at LCBO, so his hours are up and down.
Yeah.
But he was listening intently. And then, he reached out to me after that. He's like, oh, man, when did you learn how to do this? And so we stayed in contact. He did not do anything that day. And then about 6 months later, I think he got like a little bit of a bag. It was like $200 that he wanted to spend.
Yeah.
Mm-hmm.
And then he called me. He's like, oh, man, where would you put $200 if you had $200? And I was like, oh, fantastic. Okay. So let's sit down. And what he did was, he, first of all, was like, okay, I need to find a way to know this financial stuff.
Right.
He did not know whether he wanted to invest. He did not know whether he wanted to buy something.
Mm.
It's just like, can you cut through this financial stuff? I was like, the best thing you can do right now is create a habit of investing. So before you even talk about how much money you have or how much money you don't have, creating the habit of investing is actually the biggest investment you can make. Because the habit is going to be harder when you have money.
Mm-hmm.
People think it goes the other way around, like having money makes you want to invest. No, having money makes it harder for you to invest.
Yeah.
Because more money buys more good things, not less. So if you have the habit and you say, okay, every time I get paid, I do invest, and you can automate this. So the question that I went through with him is, okay, first thing you need to do when you're investing, this is a fundamental table stakes. Understand your risk appetite. There's some people, if they lose their money, they're not going to sleep at night.
Mm-hmm.
There's some people that if they don't make a huge return, it's fine with them as long as they can open their app and their money is there. So there are regulated ways of finding somebody's risk appetite. There's a questionnaire, investor risk profiler, that every single client has to go through to determine their risk. And their risk is categorized into 4 different categories. So you're either conservative, you're balanced, you're growth, or you're aggressive growth. So you're categorized into those 4.
Yeah.
So you're conservative, balanced, growth, or aggressive growth. And once you complete that, and this considers a lot of, this questionnaire itself was created by the government to respond to the, I think, 2008 financial meltdown. So once you go through that and you discover, oh, I'm balanced or I'm conservative, then you can go into the open market and find things that you want to buy.
Yep.
So now, what are those things? So the first thing is knowing yourself. This is my risk. Second is, do you get to choose stocks?
Yeah.
And I think this is where people start to think, I need that stock picking education. Well, I have very good news. Nobody can pick stocks. Nobody's good at picking stocks.
Nobody?
No one. It's like 97% of money managers, they don't beat their index. Stock picking is not something that somebody should ever be recommended to. But the good thing is, you don't have to pick stocks. And it makes it easier on you too, because you don't have to pick stocks. So then what you need is to find somebody who has already picked a whole bunch of stocks, and there are two different ways to buy those different buckets.
So somebody, you mean an individual, or
it could be an individual, it could be
yeah.
So in the financial world, there are some people who do it. Some banks actually have their own. Like RBC has one of the biggest funds. The RBC Select Balance Fund is the biggest in Canada, because most people identify in that balanced. So now when you hear balanced, now you understand it's a risk level.
Yeah.
So most people identify themselves as balanced. Like, I want a little bit of return, but I'm not willing to go like all the way.
Yeah.
So this one is like 62 billion. They keep adding more and more and more money. And what RBC has done is it has designed a fund with enough stocks and enough bonds to make it good for a balanced risk appetite. And they've picked the stocks for you. So when you go and you buy that fund, there's like 300 stocks in there. And you know that the return is going to be what they say.
Yeah.
And put a pin in that, because we'll come back to the fund when it comes to fees.
Yeah.
But that's how you select what to buy. Instead of picking individual ones, you go with either mutual funds. The other one's called ETFs. Is usually they follow what the market is doing without having somebody pick stocks. And guess what? They actually do better than the mutual funds that somebody has to pick stocks for.
Okay.
So it turns out that they charge less fees and they perform even better. So most people start their journey with the mutual funds. They go to RBC, they get this balanced fund. 2-3 years down the road, they have more confidence. They're like, okay, I need something that performs a little bit better, even for my balanced risk appetite. So they go to a balanced ETF. And then they find out, oh, okay, this is actually doing good.
Yeah.
Because the fees are less. And then they go to an index fund. But you have created a habit.
Yeah.
So right now, at least to answer both of your question and concern, start the habit. If it's $10, let it be $10.
Right.
But make sure you automate it, and you're building that juice of, I can do my own investment.
Right.
That gives you so much confidence when you open your app and you're like, this is my portfolio.
Yeah.
And you're starting to see a lot too in social medias, where people are like really showing you how much money they have in their portfolios. Yeah.
The trading thing, the trading stories.
So that's something we should also address. If your values include building long-term wealth, somebody recommending trading, especially financial influencers, have these deals where they deal with the people selling commission fees, or people selling crypto or whatever, that if they recommend to their audience, buy this thing, then they get a cut.
Yeah.
So then if your values are like, you want to trade, you want to be amongst the in crowd, that's fine. But if you want long-term investment, something that grows more predictably, you will end up just buying whatever is in the market and staying with it. Let me finish the story. I just realized I dropped the story
Of the young guy.
So young man decided he's gonna start with $30.
Yeah.
We did his risk. His risk was balanced. So balanced usually means you can take 60% to be equity, 40% to be bond. This part you don't have to memorize, just it's a way of balancing it. Think about it this way: the equity is the one that is aggressive, that shoots up, and when things go bad, the bond shoots up.
Right.
So they kind of work against each other.
Yeah.
But they allow you to smooth out the returns.
Right.
So he decided he's going to do $30 every time he gets paid. So we divided it so that $20 goes into the general market fund, which is called VFV. It's a very popular fund.
Stand for?
Vanguard Full Market.
Oh, okay.
And I do not know what the other V is.
So would that be, is it a bond?
No, that's an ETF.
ETF. Okay.
It's a cheap ETF.
Yeah.
And then we got him $10 into a bond that is VCIT, which is like all these big companies.
Yeah.
They sometimes give out, they want to expand into AI. They want money. So when they want money, they tell the market, we want money, we're willing to give you 6%.
Yeah.
So somebody goes and buys that, they put it in a package, then you can buy it on the stock market.
Okay.
So that helps you balance out. So on the bond side, because everything is certain, that money is going to come in regardless. On the equity side, you own part of the company.
Right.
So if the company does well,
Yeah.
you do well. If the company doesn't do well, you don't do well. So that's why it has all these mood swings.
Yeah.
That every day you hear on CNBC, the market is down like 300.
Yeah.
Oh my God.
So your equity
Yeah.
just dropped, but your bond is doing good.
It's doing good.
Yeah.
Over the long term, equity will be the one that gives you all the big returns.
Right.
Yeah. And a general market fund like that returns like 13%. If you were to buy a bank fund of similar, it returns 9%. So in retirement terms, that's the same as working 4 more years.
Wow.
So the fees become a real issue.
Yeah.
Do you feel more confident about like being able to create a habit?
Absolutely. The only hardest part actually I was facing the challenge was I didn't know what all these terminologies are for, right? Like when I open these apps, like the Wealth Simple app, right?
Yeah.
I just see like a bunch of numbers, and there's the ETFs, and then there is like stocks, and it says bond. It says so many things, and I'm like, okay, which one gives me the money, right?
Where do we make the money? Where's the button for the money?
Yeah, which one gives me the most money, or where do I put my money? Because like there's one, I think it's probably the ETF that I tried. For example, I put in $30, and it's been like 30 and something cents after a whole year. I'm like, what is this, right? I thought I'll come back and be probably a millionaire.
So that's actually talk about that. First of all, I'm glad your $30 is still there.
Yeah.
Yeah. Second, you did not create the habit.
Oh, of putting on more. Yeah.
One time is not like
enough.
Investment habit.
Yeah.
An investment habit is continuous. And if you actually put the account to be withdrawing from your personal account, then it's automatic. As somebody who's a spender, it's got to be automatic.
So they take it automatically?
Because they take it before I can spend it. Because if they don't take it, I will spend it.
Yeah.
Okay. And if you're somebody who's a saver, if you go through the risk appetite things, you might end up in a conservative. Conservative is the one that earns the least. So some of the coaching that we do is to make sure we put you in the right risk appetite.
Yeah.
If you're conservative and you're her age, then there's something more wrong because you have so much time that you can recover to be so conservative so early.
Right. Okay.
But if you're conservative and you're her age, that's good planning because you don't want to lose all this money in the market and then you don't have time to recover.
So we had conservative growth and balanced, right? Do we have more?
Growth.
Aggressive growth.
Aggressive growth is 100% equity.
Yeah.
It means you just own the companies. They do well, you do well.
They lose, you lose.
They lose, you lose.
So aggressive growth?
Yeah.
Aggressive.
And that one is the one where if you're young, you have more than 15 years to invest, you can consider aggressive growth. But it also takes a personality.
Okay.
Like a personality who's a more entrepreneurial and like risk taker.
Risk taker as well.
Yeah.
You can be young and not being a risk
100%. And you can be older and be a risk taker.
You're like, I don't have enough years to live, but I'm gonna go with it.
Like, full send.
Yeah, that's the saying.
So when it's time to invest, the other thing you have to consider is you are plugging into the most powerful force in the world.
Yeah.
The force of compounding. The force of compounding will be the reason why you achieve all your goals in the market. And I mean it even for real estate. One of the things that make real estate less desirable than the general market is because the compounding rates for real estate depend too much on inflation. If inflation doesn't heat up, real estate does not heat up. While the market itself, especially the general market that we have access to, like general S&P 500 or the TSX, these are people who have the ability to change prices more actively. Like all the companies think about, all the companies and all their products, they have the ability to change prices. Tissue paper in COVID became like diamond priced. So that ability to raise prices flows into their stock and flows into your pocket as the owner. Now, when that happens the first year, let's say if you make $1 the first year and you leave that dollar in, next time, even that dollar is going to get its own return. So it keeps on building on each other. And that is the power of compounding.
Yep.
Like one of the most famous investors say this is the seventh wonder of the world. Is it seventh or eighth wonder of the world? Compound interest.
Wow.
And when you look at where we are as a community, and I'm talking about Black people specifically, we do not participate in the power of compounding. On the real estate side, we are only 42% of us are homeowners, compared to the rest of Canada, 72% are homeowners.
Right.
On the investment side, about 60-70% of families have a portfolio, while for us, only 40% have a portfolio. And that goes all the way into pension.
What do you mean by portfolio? So that
access to the market.
Okay.
Yeah. So some money invested in the market.
Yeah.
We are underinvested. And we are underinvested in numbers as well. But the power of compounding is really what investment is all about. Find the asset, real estate. But if you want to start small, go with the market. Go get VFE, put that $30, but create the habit. The more money you make when you have the habit, that's when the acceleration happens.
Yeah.
When you get the money and the habit is not there, you still have to struggle creating the habit. Yeah.
So will you suggest to have at least a year of creating the habits before you invest? Or do at the same time as you go? I mean, as you go, you create the habit and then you invest at the same time.
The wise proverb of the best time to start was yesterday. And the next best time is today applies here.
Yeah.
When you have the money and there's a chance you might spend it, invest it. But do the right thing ahead of time. Even if you're like, okay, so I don't have the money. Let me create the habit. So you focus on the number that will allow you to create the habit.
Yeah.
If it's less than $5, then do a savings account.
Yeah.
And say, I'll do $5 into this savings account religiously every time I get paid. So then you're creating that habit. So yeah, you start now. But if you are able to take that $5 into Wealth Simple, one of the things that I did with that young man is he lives at home. Right. Because he lives at home, the advantage is that he doesn't have shocks to his budgets.
Right.
Because rent introduces an amounts of shock.
Yeah.
So because it's smooth, and if he ran into a challenge, you recall, like they're actually a multi-generational home. The grandfather and the parents are in the same home.
Yeah.
So he does not need that much of an emergency savings.
Yeah.
I was like, okay, so then let's focus on you training to invest. And starting at 20, that if he keeps on that $30 bi-weekly, it's $1 million at 65.
So, but if he learns the aggressive part of it, he could be a millionaire earlier, right?
Yes.
Because now he's taking heavy risks.
Yes. However, he will probably wake up in a cold sweat.
All is gone.
Oh,
yeah?
No, not all is gone, because it never really is gone. It's just the ups and downs. From his answers, he said that he could not handle the ups and downs. So even if he's up, because the way we are humans, we don't process things as linear as we think.
Yeah.
So he could make it all the way back up to 800,000, and it drops to 600,000, and that makes him sell and stop the whole process.
Right.
If he goes into aggressive, but his heart is like a balanced.
Yeah.
That's why it's
My
important.
question is, how long do you have to keep that into the portfolio?
For each to compound?
Yes.
Yeah.
So it starts compounding immediately.
Okay, so can you take it, let's say if it goes up,
Yeah.
can you take it out?
Like
that?
liquidation.
Yes, so I have the right answer for this, and this is going to be very useful for you as well.
Mm-hmm.
So then it introduces us to the taking it out.
Mm-hmm.
When you take it out and that compounding has worked, the government has to take its part.
Oh,
So you have to choose an account that allows you to keep that part for as long as possible before the government can tax it. So there are some accounts that help you with this. Tax-free savings being my favorite. The tax-free savings, whenever that compounding works and you take it out, it's tax-free.
Oh, that's good to know.
So the government is not going to get its cut. If it's outside of that, then government is going to get its cut. Now, if you say you're saving for retirement, you can put it in an RSP, and then they would delay taxing it until you retire at 71.
Yep.
If you say you're saving for a home, you can put it in a first home savings account, and they will delay the taxing it if you buy a home. If you don't buy a home, they'll come back and tax it.
Right.
And of all these registered accounts, if you say you're saving for education, they will delay taxing it until you sponsor somebody's education. They'll tax it in their hands. And there's another one for people with disabilities, the registered disability savings plan, that they will delay taxing it until they're 59.
59.
59.
Yeah. So it kind of helps. So when it's time to take it out, it depends on where you put it. If you put it on those in these registered accounts, there's some rules. If in a tax-free, you can just take it out. If it's in an RSP, if you take it out before your retirement, they will do what is called withholding. They will take some of that money and they'll keep it for future taxes. So the Wealth Simple will send it directly to the government. Then in April, May, when you're doing your taxes, you're gonna even out with the government.
Right.
But you can transfer it back to your account if it's in a tax-free savings, and spend it.
Spend it.
Yeah.
So investing with intention, don't you think it's heavy on young people mind, especially when you have to go through all that explanation, and it can be a little bit heavy. I mean, I have been in the finance field for 15, 20 years, but still, it's very hard to grasp every little thing here and there. So I don't know if Sana can...
I also had a question about that, since it's generally for students who are entering university or students finishing up their last year for high school. Kind of just what is your advice on getting started with investing for students who are managing school expenses on their own? And how can they balance everyday costs, save for future goals, and figure out when it actually makes sense to start investing, especially while they're dealing with student loans or a part-time job?
That's an excellent question, and it builds to what you were saying. So, this is my advice. I think the first hurdle is getting into that habit of making money.
Mm-hmm.
Find a habit of making money one way or another. Take some hours at the library, take some hours at Subway, take some hours somewhere, and then your journey has started. And so you're saying people who are now getting into university.
Yeah.
The student loans, if you have student loans, they're coming a little bit later. Mm-hmm. And as somebody who graduated with 30,000 to student debt, trust me, they're coming. Mm. And one of the challenges that I will add to the plate is that if you're facing student loans, your parents actually need financial guidance more than you do. Mm. Because you having student loans is one of the telltale signs that they don't particularly know what they're doing. Mm-hmm. And in their retirement, they're probably going to need you as you're repaying the student loans. We call that the sandwich generation. Because whatever they did wrong to make sure that you don't have your student fees covered, they probably do it for their retirement. So the first thing is try to think about it a little bit larger. Talk to the parents as well and say, okay, let me help you move forward. Now, for you, the habit of creating money, yes, you start with that. You cut some sort of hours in, and then start creating that habit. Even if it's $5, even if it's, the whole point is to get started. Now, balancing is going to be precarious. At that time of your life, things are very challenging, especially moving out for the first time by yourself, and then you have a full course load. Usually there's a new town that you're moving into, and then there's competing interests with friends, you're trying to do vacations together, you're trying to do all these summer things, and that can get expensive.
Yeah.
But create a habit of first making money and second putting that money away. With that, the first one, the habit of making money, the second one is going to be challenging no matter what, because you end up going back to your parents, and then now you're negotiating, pocket money, and you try to use the pocket money for investments. Things are starting to get a little bit tricky. But if you can create a habit of making money, and then that build on top of that by creating a small habit of putting that money away into something like Wealth Simple and buy a small thing, or a savings account. A savings account is not ideal because they return a lower rate than inflation. So your money is actually kind of melting away. But for all the young people who have that situation, especially if you're facing student loans, talk to your parents. They need you now more than ever. And if you can tell them now, you have 10 years before they need you to take on whatever it is that they are missing right now.
Right.
True. That's a good idea. That's good questions.
She's really smart. So if I got it right, there's no such thing as little money. We can invest as much as $5, right?
Yes.
And we have to get our money to the market. So that means applications, maybe like Wealth Simple, or invest. You said investment. Savings. Like bank savings is not ideal. So what are other platforms we could get our money to in the market apart from Wealth Simple so far?
Amazing. So even your bank, besides the savings, your bank will have mutual funds and other things the advisors can get you into. So now we would be a good time to talk about what it costs you to invest. Whenever you're doing it yourself, you're going to always pay the least amount. The part that scares people is like, I just don't know what to do, so I don't want to mess it up. Then the money is missing. Follows the approved on the Bank of Canada. There's approved Schedule 1, 2, 3 banks, including neobanks, that are allowed to handle money. So go with a bank that is certified, and then when you choose the products with the lesser fees. The fee to look for is called the management expense ratio. Right now, it's about 2% at the bank level. And when you're doing it by yourself in Advise Direct or RBC Direct or Wealth Simple, it's about 0.25.
Yeah.
So it's 10 times cheaper to do it yourself. And this actually cuts down how much you get back, because once the compounding works, they take out their money first. So I would advise that go to your bank first, or if you have some courage to try it and try it with a small amount, try it yourself and save yourself the fees.
Right.
Yeah. So that's why I really like Wealth Simple.
Right.
What about your company? Can your company help, let's say, young people to start something?
Absolutely. So this is a shameless plug, and thank you for helping me with that. Pocketbook Wellness. Yeah. So reach out. Pocketbook Wellness. If you type that all over the internet, you will be connected, and we'll guide you through your first habit creating transaction. Right. It's going to be very friendly, and you'll be able to do it. Eventually, that feeds into your retirement, your home purchase. We have not addressed the home and where the home fits in the investment.
Right.
But the home is very, very important. The type of peace that comes from the home is even better than trying to get the most percentage out of the market. Most homeowners will tell you, water might break, glass might break, but the fact that they're living in their own house makes it all worth it.
Yeah.
Do you have some more questions?
No, that was actually amazing. Now I know I can start. I can.
Can you do it
put
yourself?
I can do it myself.
All right. And you how much do you need to get started?
You said little money. There's no such thing as little money, right? Like $5. I gave an example earlier, right? I put in $30.
Yeah.
And then I stopped. I thought it's gonna, compound to much money. But again, I think I can add on like a little bit more, right?
Yes.
So what would you advise me, like, if I'm really ambitious and I want to, like, get so much money at a young age, right?
Great question. So the thing that you can adjust to quicken that whole process is your savings rate. Right now, Canadians are saving 7% of their money.
Yeah.
If you adjust that savings rate for yourself to be 25%, you can retire in 18 years. No matter
in 18 years?
18 years.
Yeah. No matter your income level.
So 25% of my income.
Yeah.
If I could save that.
Yes.
But again,
take your check, you cut it in quarter.
Yeah.
You put the quarter in the market.
Where exactly in the market? Where exactly?
First of all, this is not financial advice, but my calculations are based on VFV.
VFV.
So the Vanguard full market.
Yeah, just try that.
Low fee, they charge 0.25 and they return 13%.
Right.
You will retire in 18 years.
Okay.
But most Canadians are going to be around the 7 to 10 to 15% savings rate. That's a 40-year retirement kind of curve. So it's you can see it's not the money part; it's the habit.
It's the habit. Yeah, absolutely.
So you can change your savings rate. You can get yourself retiring
earlier. Yeah. I've heard a person say it's not about what you get; it's who you are. Right? Mm-hmm. It's not about so much money, because I've kind of made a little like money that looked like it was so much for me, and I've lost it. Right? But since I started building the little habits I never acquired at a young age, I realized, what? There's no such thing as little money, because again, at the end of the day, I'm able to, I have enough savings. I can buy whatever I want, right? So it wasn't about, because like I said, I've earned so much money and I've lost it. But even when I started earning little money after building, such great habits, I was able to save so much and like keep some money in my pocket and, invest in, buy some nice things, and I was able to do so much, right? But all, because of, the habits I built, right?
Yeah, and the building habit part, this is part of it. Like people taking some time to listen to a financial wellness talk, a financial literacy talk. Mm-hmm. That's investing. Yes, you don't see the money, but even stopping the mistake from happening is money in itself. So this is part of the investing.
Which is what a lot of people are lacking, like knowledge. Because knowledge can be something that brings money.
Absolutely.
Because without knowledge, you can have money and then money won't do anything. But if you have knowledge, say, JP is here to help.
Yeah.
Then you can come and talk to him, and the money that you have may be built, and then you have more money out of it.
Absolutely.
So knowledge. Thank you so much for the knowledge that you are giving young people, even seasoned people.
So we're coming to Pocketbook.com wellness.
Yes, Pocketbook Wellness.
Yeah. So Pocketbook Wellness